Hi there, my name is Mark Gardner. I'm founder and CEO of MPC Markets. I'm just going to run you through our modern wealth formula as applied to those in the growth phase of their wealth building, called the Wealth Builder. Just some very quick housekeeping. This communication is general advice only and has been prepared without taking into account your personal objectives, financial situation or needs. Past performance is not a reliable indicator of future performance. Some products discussed in this communication may involve counterparty risk and put 100% of capital at risk during investment. So the old method, essentially, when you're building a portfolio or building wealth, in Australia particularly, has been property investing. So you save for a deposit, you buy an investment property, property appreciates, you get CGT benefits and negative gearing benefits, and that's how you accumulate. So the property investing problem now for a younger generation is, property compared to income is nowhere near as cheap as what it used to be. You know, our parents, your parents was more around the 4 to 5 times income and average annual income mark. It's now around the 12 times. So that means you've got to save for a much higher deposit, and that savings not taking advantage of the leverage. And look, to be honest, it wasn't property that necessarily made the older generation rich. It was the leverage that they used on that property that really built their wealth. But now there's no 50% CGT discount, and there's no negative gearing for rental properties. Rental yields are appalling and have been for some time. And without those top 2 points there, it really has made property almost off the table. So, but look, this isn't necessarily, I mean, you need somewhere to live. This isn't necessarily whether you're looking for a house to live in. But even if you're saving for that deposit, this product will get you there quicker. So we use structured index investing to do this. And essentially, it's the same as the ETFs or the index ETFs you very likely hold in your industry super funds or via ETF providers like Vanguard or BetaShares. But we use a structured investing sort of technique, which is modern, new to Australia, but very common overseas. And it provides us with capital efficiency, i.e. some leverage to the upside. It's done by a deferred purchase agreement or a DPA, which actually makes the investment tax deductible because negative gearing still applies in shares. And it reduces your risk in the event of a market crash because it sets a defined worst case for your investment. So the modern formula is have some income investments, which are usually pretty boring. But in that growth phase, you would just allocate less to it. Pool 2 is have some growth and some structured growth as part of your portfolio. So the income investment, look, term deposits aren't really going to help you too much. You probably want to look at some bond ETFs, etc. And that'll sort of help build your foundation and essentially pay for the upfront cost of these index investments. The index investing is a really common thing. I don't need to probably explain a hell of a lot about it. I think you probably all know about it. If not, there is a wealth, there is a wealth of education on this sort of stuff on our website. But look, indexes are designed to go up. The worst stocks get dropped out of the bottom of the S&P 500 index, and they're replaced with the performing ones. I mean, that's a tactical advantage just straight there. They're very diversified. They're very hard to beat. 82% of fund managers don't beat the index. So the S&P 500 is one of our favorite indexes because it does perform very well and it is very broad. And if you're looking at something like the ASX 200, it doesn't perform as well on an average annual basis, and it is very concentrated in banks and mining stocks, which are very cyclical. So the structured index investing upfront, anywhere from $10,000 to $17,000 cash upfront, controls $100,000 in notional exposure to that index. So you're getting roughly around that sort of anywhere from 5 to potentially 10 times leverage on your money. And think of that first initial payment as you're paying for your leverage, you're paying for your features within the index product. It's classified as an upfront interest payment, and which makes it tax deductible. That also reduces your cost depending on what tax rate you're on. We have terms of 3 to 5 years. We have underlyings across many global indices. It just depends on which one we think is value at the time. 100% of this capital is at risk. However, you're getting $100,000 exposure for that amount. If you held $100,000 in an ETF on the underlying S&P 500, and the market did have a collapse, say, like 2001, you would be down around about $49,000, $50,000 on that investment. Whereas with this, what you put in is the maximum you can lose. So it actually, in effect, kind of caps the downside. There's no leverage to the downside, but your exposure to the upside is 100K. So as I said before, the older generation got rich not necessarily on property, but on leveraging property. So this gives you a massive advantage. And shares have always been regarded as far too volatile to do this sort of thing. However, if you can cap that downside and take advantage of the average return in the in the ASX 200, for instance, is around about 9%. The S&P 500 is around about 11.5% over the last 20 years. And ride this out and then have that protection, then you can apply that high level of leverage without the concerns of share market volatility. So the modern formula, you would end up putting in enhanced growth there, an allocation. You're getting all of this extra exposure, and then you're able to allocate a slightly bigger amount to income, which is not an exciting investment. However, the capital efficiency allows you to do that. And you can probably get more exposure than you would normally be able to get just doing one-to-one cash investments in ETFs. So it gives you a massive advantage over a long-term period to take advantage of the average returns of the global indices. If you want to see what your modern sort of 60-40 looks like, and that's what the modern wealth formula can do for you, you can get a portfolio review. You can scan this QR code and get all the information. Or you can get in touch with us at info@mpcmarkets.com.au. If you want a more detailed explainer of the modern wealth formula, and this can be essentially, it's very flexible and can be applied not only to younger generations, pre-retirees or retirees. You just set where you want to set your risk at. Our co-founder, Kai Chen, has got a very detailed explanation. And you can watch that next up on YouTube, or you can scan that code that was there previously and have a look at the landing page and watch that video to get more detailed explanation on the investment product. Thanks for listening, and we'll speak to you soon.